Theta gang generally refers to option traders who prefer to sell options rather than buy them. This is kind of a vague term, but broadly you could say that Theta gang's goal is to benefit from theta decay, or time decay, for those of you who aren't fluent in finances. While this can include multi-leg strategies like short condors and put credit spreads, I'm gonna keep it simple and focus on cash-secured puts and covered calls. All options expire, and what this happy state means is that they lose some of their value for every day that goes by in which they don't move toward their strike prices. If you spend any time on Wall Street bets, you'll probably see people sharing fat losses, many of which stem from their purchase of out-of-the-money options. And Wall Street bets degenerates purchase these options from the less gambling-inclined members of Theta Gang, who can be thought of as people who would rather sell lottery tickets than buy them. Unfortunately for option buyers, for those lotto tickets to be worthwhile, they need a thing to happen within a finite period of time, meaning they need the underlying stock to move closer to the strike price, preferably in one sudden lurch, so they can cash in their lotto ticket for 100% ROI and finally get some sleep. Obviously, I'm kidding about the selling for 100% ROI part. You and I both know that returns of less than 1,000% are insufficient for the average Wall Street bets degenerate. We also know that in addition to being stressful and fucking up your sleep, buying out-of-the-money options can also have other side effects, like your bank gently encouraging you to vacate your house, while your family puts out some feelers for a new dad. Option sellers, on the other hand, generally don't have this problem because selling options is a galaxy brain way to maximize tendies over time, whereas lots of option buyers are basically engaged in a very convoluted double or nothing sort of deal. And giving option buyers on Wall Street bets 50-50 odds is probably being generous. I'd rather take my lessons from my queen, Nancy Pelosi, who prefers deep in the money calls. I've talked about some of her stock picks in a previous video, which inspired me to copy her moves, do my own research, and coincidentally enter two of the same positions that she entered in December of 2024. I entered my Google and Nvidia calls in late January of 2025, close to her basis. And it goes to reason that there are worse ways to invest than tying your financial future to one of the most prolific insider traders to ever play the game. But unlike Nancy, $10,000 to gamble on leaps is actually kind of a lot for me. But I further justified what I'm calling my reasonable man's YOLO by telling myself that it would make for some decent content and an interesting investing arc which I could share on YouTube. Basically, I used your viewership to justify doing stupid shit. So be a sport and hit those like and subscribe buttons because my financial well-being may be at stake. Unless you think it would be funnier to watch me go bankrupt. As of February 22nd, the leaps I bought appear to be offsetting each other. More or less. But I suppose it could be worse. They could both be down 29%. But I have faith in Jay Powell and the Trump administration to provide a calm, steady hand that will ensure the stock market continues to... Okay guys, I'm actually kind of panicking. I didn't think it would get this crazy this fast. That's what I get. That's what I get for trying new things. Let me know what you think I should do in the comments. Just be sure to say not financial advice 3 or 4 times so the SEC doesn't send jackbooted thugs to kick down your door and drag you off to El Salvador. Anyway, I figured experimenting with going long on options would be an interesting change of pace. I made too much money last year, so I started off 2025 feeling cocky enough to return some of those gains to Wall Street. But if you watch this channel, you know my usual speed is to sell calls and puts to the crackheads on Wall Street bets. Selling covered calls is like borrowing against your future gains. So if you think the future outlook kinda sucks, it can be a good strategy. But if you think the future outlook really sucks, then maybe locking up a bunch of capital on stocks that'll become worthless after one of our very stable and normal world leaders has a bad day, and decides to finally push their big red button, may not be the best move. You don't want to be forced to hold on to stocks that are overall losers in exchange for a small upfront payment. Let's say you own 100 shares of Coal Corp at $10 a share, meaning you're in for $1,000 total. Coal Corp makes toys, but what they do is irrelevant, because you gotta remember, we are degenerate asshole speculators, not business owners or whatever. I'm out here on the periphery, trying to make a few bucks. Anyway, let's say you believe the world is ending, which is not an unreasonable assessment. You may decide you want to be a gigabrain galaxy chat in short delta, so you buy a put option on the SPY. If the financial markets collapse, you'll probably make a tidy sum. But the problem with buying premium this way is that you put your entire collateral at risk. You have to actually time the market right, or know a thing is about to happen, which, I'm sorry to inform you, you do not. If you're watching this video instead of sitting at Davos getting wasted on dessert wine next to Willie Gates, you don't know what's going to happen. The only thing peasants like us can do is hedge our bets and be wishy-washy. And the best way to be wishy-washy is to neutralize your delta exposure, which is a very jargony, well actually milady sort of way of saying sell puts and covered calls. These are neutral or slightly bullish bets because they both benefit from markets staying flat or going up slightly. And if you were going to own 100 shares of Coal Corp in a sketchy market anyway, with no plans of selling, it's probably not the worst idea to hedge your bet by selling some option premium. Let's say you sell a near-the-money call expiring in a week with a strike price of $10.50 and collect $11 in option premium up front. This quote-unquote passive income makes you feel like you're playing 4D chess against the brainlets who only know how to buy low, sell high. These normies don't realize that this $11 is worth more than just a 4-day-old deli sandwich. As a big brain who took Finance 101, you understand that an $11 weekly payment annualizes to $572, representing a more than 50% gain on your initial $1,000 investment. This is the sort of return that can beat out most US senators. So thinking highly of yourself, you sell this $10.50 strike option, and then 3 days later, Coal Corp loses 50% of its value because the Trump administration decides to put tariffs on the Chinese rubber and plastic components the company needs to make their plastic toys. And so the company has to find another country full of people who are great at math and that pays its workers Oompa Loompa wages to buy raw materials from. What all this high-level economic chicanery means for you, the little guy, is that you're now down $500, wiping out 78% of your liquid net worth. In hindsight, locking yourself into a position in Coal Corp for the equivalent of a cold deli sandwich doesn't seem like such a good idea. However, you only lose when you sell. So if you hold on to the company for 2 more years, you can maybe reduce your basis enough to convince yourself that it's okay to tie up your capital for an extended period of time. Eventually, you'll give up on this position, telling yourself that you're being smart by harvesting the tax loss in December. And you are selling the shares to harvest that tax loss, not because you can't afford to pay your phone bill. Yeah, definitely not that. If you adhere to Theta Gang principles, it's easy to pretend you're generating passive income by selling premium via covered calls, rather than just trading away your future capital appreciation. You know what they say about the velocity of money? A $20 premium today could be worth more than a $30 capital gain 2 months from now. Selling premium is particularly appealing in flat or moderately bullish markets. Like I said before, option sellers benefit from time decay because all else being equal, options lose value as they approach expiration. The person who bought the option you sold is basically buying a lotto ticket, hoping for the underlying stock to move toward the strike price. The main benefit of selling puts is that you can pick whatever strike price you'd be happy to buy the stock at, meaning you don't technically lose anything if the put option were to get exercised. You'd simply be assigned the shares in a stock that you wanted anyway, while being paid a premium in the meantime. It's kind of win-win. That's why I like doing it, despite it being kind of capital intensive. The benefit of the other main Theta Gang strategy, selling covered calls, is that if you sell your calls at a far away enough strike price, a price at which you wouldn't mind selling your shares and locking in those capital gains, it's another win-win situation. Because if the stock doesn't rise to your strike price, you get to keep the premium you collected and just sell another covered call. You can do this again and again until the stock hits your strike price and your shares get called away at a price you're happy with. The key is to not get too greedy and sell these call options too near the money, because that might force you to sell your shares at a price that you wouldn't be so thrilled to do it at. One of the cons of these Theta Gang strategies is that selling premium this way means you're dealing with defined returns, unlike buying options, which theoretically offer unlimited gains. Selling covered calls or cash-secured puts means you know what your max return is going to be up front, the amount of premium that you sold, which isn't as exciting as potentially hitting it out of the park with a well-timed entry into a call option, for example. If you're an options seller, you've probably kicked yourself for selling calls a little too near the money, only to have the underlying stock surge 15% on news that nuclear war is imminent. We've all been there. But despite the pain of occasionally snatching defeat from the jaws of victory, I continue to believe in the superiority of Theta Gang. Let's say a lotto operator collects $1 for every ticket they sell. Sure, the buyer has a chance of becoming a millionaire overnight, but who would you rather be in this scenario? Who's getting paid out the wazoo over the long term? Exactly. At the end of the day, it's a numbers game. And most of the people buying those lotto tickets will lose over the long term. They may even have to supplement their income by offering discount services behind the Wendy's dumpster to Theta Gang. Another benefit of Theta Gang strategies is that risk management, assuming you actually do any, is a lot easier because of the defined return nature of selling puts and covered calls. With these strategies, you really only have to manage your downside because your max profit is defined on the front end. It's just the price you sold your options for. Easy. But let's say you're an option buyer. You buy a call option on Corp that goes up like crazy. Now you have to debate yourself on whether you want to lock in that 489% unrealized gain or wait for it to go up even more. You spend an hour or two fantasizing about how high this thing could go until your underlying suddenly tanks, forcing you to settle for closing out the position at a 99% loss. Don't worry, you'll get them next time. Remember friends, if it's good enough to screenshot, it's good enough to sell. If your call loses 50% of its value, you're now in the unenviable position of trying to figure out whether you still believe the underlying will move in the right direction. This might have been easier if you had actually done your due diligence, but doing it now under the duress of imminent financial collapse is probably just as good. It's the only way you'll learn. What I'm saying is that buying options has a higher reward potential, but it's also higher risk, and if you don't know what you're doing, higher stress. I've never been great at buying options, so I'm practicing a bit more in 2025. Maybe I'll make a video about Delta Gang at some point, even though that's not my strong suit. I'm curious to know if any of you consider yourselves to be net buyers of options. If so, let me know what you're doing in the comments and how it's working out for you. Both buying and selling options can potentially allow you to benefit from volatility mean reversion. This is just a jargony way of saying that volatility tends to contract to its historical average after a period of being elevated. As volatility contracts, the cost of options decreases. This is because volatility is one of the variables that determine how much an option costs. A more volatile option means the underlying stock's chance of swinging wildly increases, meaning its options have a higher chance of going in the money. This increased risk is therefore priced into the cost of the option. The way to benefit from volatility mean reversion as an option seller is to check your underlying stock's IV rank and try to sell premium when the score is on the high side. A higher IV rank means that the option's volatility is high compared to its historical average, and because higher volatility means more expensive options, it can be a good idea to sell premium when the stock's IV rank is high. You can look up the IV rank for your individual stocks before selling calls or puts. But as a broader check, you can also look at the VIX to gauge overall market sentiment. A higher VIX probably means that option premium is going to be more expensive for stocks across the board, which means that it's a good time to sell premium and a bad time to buy it. If you're an option buyer, IV rank is even more important because buying premium is already riskier than selling it. So you need to pay extra attention and make sure you're not overpaying. Ideally, you want to buy options when a stock's IV rank is low, so that you can benefit from your option's value increasing as volatility begins to expand again. Theta Gang is more like the turtle in the Hare story, slowly bleeding Wall Street bets Delta junkies like the fat greedy hogs they are, and stacking gains over time. I think it's hard to argue with the fact that being a net buyer of options is a harder skill to master than being a net seller. Knowing when to take a gain, and worse yet, knowing when to cut a loser, is quite challenging. Closing a long position at a 50 or 70% loss and having enough positions on to negate that loss so that you're profitable over the long term is a lot more stressful than just sell put and then being like, oh no, I was assigned the shares of Google. Oh gosh, this is terrible, whatever will I do? But we all know that options, however you play them, can be a dangerous game. Even Theta Gang can technically have unlimited risk if you're enough of a degenerate. This is because somewhere out there is a brokerage who is willing to enable your addiction to gambling in the financial markets and allow you to sell naked puts and call options.
The Black Death is coming. The great pestilence is finally upon us. Repent! Repent!
Unlike covered calls, where your short position is covered by actual shares of the underlying stock, selling naked can expose you to huge losses if the underlying's asset price surges. But let's get back to the simple stuff. Covered calls. If you sell a call against 100 shares of stock, a large sudden downward move in the underlying's asset price can quickly erode the value of your short position, which is good. However, your shares now have a fat unrealized loss, which is bad. If Corp's stock price suddenly drops 20%, that short call against the shares that you sold, the one you collected $11 for, may suddenly only be worth $1, meaning you can buy it back for $1, closing out that position and releasing your 100 shares of collateral in Corp. Closing this option means you've recognized a 91% gain. You crafty devil you. You're now free to sell those shares, or sell another covered call. Your $1,000 cost basis, reduced by the $10 gain on that short call you closed, means your new basis is $990. So if you lose faith in Corp's shares and want to sell, You can now do that for the current share price of $8, eating a net loss of $190 on the overall position. I view this scenario as a pro rather than a con because you've reduced your basis by $10. A $190 loss is better than a $200 loss. But I also think it can be a con if selling covered calls encourages you to hold on to shares of a crappy company you've lost faith in, also that you can generate $11 of premium. Which is why it's best to sell covered calls on stocks you wouldn't mind being locked into for a year or more if the price were to suddenly tank. Monitoring and managing option positions that fall under the Theta Gang umbrella is admittedly easier and less stressful than those that involve buying premium. But you still need to have some understanding of factors like volatility, delta, and theta. There are short and long-term economic trade-offs that don't come into play if you're not an options gambler and your whole strategy is just buy low, sell high. But we know that's not you. If you enjoyed this video, remember you can support this channel by becoming a member on YouTube or Patreon. Being a member means you get to give me $3 every month, which is a wonderful thing.
Help me, I'm poor.
I'll need that $3 because things are looking precarious with my degenerate foray into Delta Gang.
Oh my God!
And I can't continue making exquisite investing content if I'm living under a bridge. I will see you in the next one. Bye for now.